What is up, everybody? My name is Matthew, and today we're going to be looking a little bit into Netflix stock. So Netflix actually has been taking a huge downturn for the most part, and from what we know, it's not looking pretty good. However, they did have a pretty monstrous day today. So doing a little bit of Netflix stock analysis, we're going to go into what we should be buying it at, or really trying to look at the numbers and trying to see if everything makes sense, and really just digging a little deeper into Netflix overall as a company. So Netflix today is actually up 6.9%, and after hours they're actually up 7%. So combined maybe about 13%, if you will. And that's pretty much in one day. So Netflix seeing this huge upward spike move, and all the way at 200 now. Before they were actually at 700 at the peak, but now we've seen Netflix come down to 200 levels, which is pretty remarkable because the last time we saw 200s was actually in 2017. And we can see from right here that Netflix actually hit this $200 mark in 2017, early 2018. But overall, still a remarkable move. And till this day, from our high, we're still down 70%. We did take a humongous downfall. So now's the time to be looking at Netflix if anybody is actually interested in looking at Netflix. So they actually just came out with earnings today that came out around 3 p.m. Where I am, Pacific time. But looked into their earnings a little bit. They actually were able to go up 8% after these earnings, and that is a very big thumbs up because that's very good on them to increase their earnings as they did. So came down to it, EPS was actually up by 8.5%, and revenue actually missed the estimates of 0.8%. Now, not really looking into much of the estimates here, but they did actually surprise. It's pretty good to see that your company actually did surprise on estimates, just because Wall Street is predicting that, everything is going to be going back to normal. People are going to be getting off their behinds at home and stop watching Netflix, right? Everybody really starts working once we get back to the regular world, and not really people are watching Netflix as much as people would intend, right? So Netflix actually said, hey, we actually got the numbers this time, and we're actually gonna come out a little stronger than what we intended. So Netflix actually said that they were losing fewer subscribers than expected, and says that their cheaper ad tier is coming in early 2023. So they actually stated that they were going to be expecting a loss of 2 million subscribers for this quarter, but they actually lost only 970K, which isn't that big of a move. I mean, it's pretty big compared to the estimates, but if you think about it, you're still losing 70,000 subscribers. And overall, it just comes down to how many people can you keep on your platform, because there's nothing that you're really selling besides a subscription. So pretty much once you have that subscription, you'll keep that usually. At least my family does, right? So some of the things that actually went really great for Netflix was their Stranger Things that just came out. I think season 4 came out, and that everyone's like going crazy about, right? And pretty much once one of these shows comes out and they're a huge banger, it's really hard for Netflix to decline in terms of subscribers, just because a lot of people really want to watch that show and there's a lot of demand to watch that show. So people are thinking, hey, why not just keep around the extra subscription and watch this Netflix show called Stranger Things. And I think that if they can keep coming out with these bangers, then it's going to be very good for Netflix. But I think historically, once Netflix does come out with such a great show that does really great numbers, then you see the churn in subscribers actually decline, because people just want to stick around more and just watch that. Now, we can see that Netflix is actually going into a strategy shift here. So Netflix actually plans to partner with ad-supported subscription plan Microsoft, just because they're trying to get more exposure into this business world and really get more subscribers that way. But I think their process is really, can we offer a free product and then turn those people into paying customers later on? And that's really what they're trying to do with Microsoft here. But some people might think that this is pretty strange, that why are they working with Microsoft instead of Google? We know that Google is the #1 ad player. Why not work with Google to make sure that we can get our ads through? And this is There's a lot of reasons as to why they're working with Microsoft. People say that they have like a current past of like the executives working on the team there and stuff like that. But something that really stuck out to me was that it's pretty strange for them to work with Microsoft just because there could be a potential buyout in the next 5 years. It's just rumors. I don't have any idea if that's actually true or not, but there could be a potential buyout in the next couple of years. But we do know that in the next year or so, Activision is actually going to be bought out by Microsoft. So we could see that, take about 5 years till this actually does play out, if there is actually going to be a potential buyout, just because they're using a lot of capital on Activision Blizzard, where they might not want to use that to buy out Netflix, being a almost $80 billion company. So, but yeah, Netflix actually is going to be cracking down and trying to get more revenue as they're just cutting password sharing. And they're trying out this new thing where Netflix will actually start charging some of their users an extra fee if they want to use their account in additional home, as they try to generate extra income from subscribers sharing their passwords. And with no password sharing, it's pretty hard to see that happen. But if it actually is likely to happen, then we are likely to see a use of ad-based services from people like you and me who are too cheap to buy Netflix. I don't buy it. My parents do, and they love it. But overall, if this actually happens, Netflix does get more money at the end of the day from advertisers. And once they're able to give this free product out, they're able to earn money from ads, which is pretty great considering that there is going to be probably a large user base for that too. Just because if you look at Spotify, we can see that a lot of people are actually using Spotify freemium and then upgrading to premium later on once they're too tired of the ads, right? So get them hooked on the Netflix originals and then convert them later, which is a decent strategy in my opinion. But how much does really Netflix lose from password sharing? And that comes out to about $6 billion a year. And overall, that $6 billion could just help out them in creating more Netflix originals or helping out the bottom line and becoming more profitable at the end of the day. So which is why we see Netflix trying to go after this market share overall, just to try to compete against, Hulu, and who else offers ads? But Hulu offers ads for sure. So they're trying to get into that space and really combat against Hulu, I guess. And some may see this move as quite bullish and that Netflix can actually make more money in the future. However, we can't go too fast and we must stop right there, just because we have to do a valuation check and see if Netflix is going to be overvalued or undervalued based off their multiples and financial standing. So going into the financials of Netflix, we can see that their sales growth, or the revenue for the year, actually was up compared to last year. And in the past 5 years, we've just seen upward growth of double digits and probably averaging about 23, 25 about there. But overall, we can see sales growth increase, or actually sales growth does decrease. Sales growth does decrease as they're still able to earn more revenue at the end of the day. However, the percentage increase is just less every single year. Now, looking at cost of goods sold, they're actually spending more money every single year to try to produce these Netflix originals and just to create great products for you guys. However, when the cost of goods does go up, their revenue does go up. However, they are spending more, meaning that they are able to grow at a lower rate, considering that they don't get that much revenue at the end of the day when they spend that much money. So going a little deeper into the valuation measures, we can see that they're actually $84 billion, and they're currently trading at a forward PE of 17. Usually in the stock market, we're looking for anything from about 20 to 25. However, I kind of want to wait until the PE is 15, and that would be pretty good for us, because you pretty much want to buy undervalued companies, not companies that are trading at, whatever the standard rate is for the other companies that are technology in the stock market, right? Also going on, the PEG ratio, or price to earnings growth, is for the 5 year is 2.44. However, this is sort of bad since they are actually lower earnings growth, and as they're trying to grow, they're really not growing as fast as they can compared to how much that they're valued at. So we're actually not getting a great deal in terms of PEG ratio. And looking into price of sales, one of the most popular valuation metrics to look at, we're at 2.83. However, the S&P 500 is trading at an average of 2.44. So we're like almost there, but not yet. And if this price to sales ratio actually, drops and we do see a little undervalued Netflix stock, then we could also look at that as a very great purchasing opportunity to see that they are actually undervalued in price to sales. Looking at price to book, they're actually at 4.79, and this is kind of over that 3.0 that we want to be at. So they're actually just trading at 3 times as much as the assets can be sold for. And we want to see this lower just because they could be having more assets than what they're actually be trading at. And looking at EV to EBITDA, they are trading at 4.75. And in the stock market, we really want anything under 10. And they're great sold on this one. Golden solid on this one. But looking at this little chart right here, we could look at the price to book ratio and see when was the last time the price to book ratio was at this level. So we can see that actually in 2012, we saw a book ratio of 4.2, which is kind of in line of 4.7, which is the last time we saw that. And looking at price of sales, we saw in 2013, they were at a price of sales of 2.98. Though in 2019, they did drop a little more. No, not 2019, 2013. They actually did drop a little more. We could see the price of sales drop a little more as time goes on. We really don't know where the price could move. However, if it does, it just looks better for long-term investors that are invested or interested in investing in Netflix stock. And looking at PE, the current industry PE average is about 15. So at 15, the price to earnings multiple, and at $11.80 of EPS, we get about $177 per share. And pretty much you're kind of looking to buy Netflix stock at anything under $177 per share or lower. The lower you could buy it, the better, of course. However, you cannot time the market, right? So dollar cost average, once you hit 177, and just try to work your way to get the best price point you can, really, right? And looking at PE, the last time they were at a PE similar to what we are now at 17.4 was actually in 2011, where they were at 16.66. That's pretty long time ago. I was young. But yeah, it's been a while since we hit those levels, and if we do see hitting 15, Netflix stock does really look really interesting at the end of the day. So some of the closing remarks I have to actually make are that they have to innovate. I think Netflix really needs to innovate in terms of being a quote-unquote growth company in the FANG that they call it. But going into it, ads are actually going to be helpful for them, I think, whether that be producing original series and really trying to get this ad service out there. And they got to do this without breaking the bank. We know that Netflix does take on a lot of capital to make sure that these productions do come out well and do come out great for everybody to watch. If not, I could see Netflix actually having a stagnant business and kind of growing slower as they progress. And you can't really expect double-digit growth from then on if they aren't able to innovate and grow quickly. Now, I think regardless, they are still going to be number one in video streaming. Will they remain number one? I honestly do not know. Nobody knows. Nobody has the Golden Globe, right, to see who's going to be the winner at the end of the day. We know that other competition has come into the market, like Disney, Hulu, Paramount Plus, and even more. It's just a bloodbath for streaming right now. But if you think that Netflix is going to come out on top and produce really great original series at the end of the day and really pull people in like what they did with Stranger Things, I think that Netflix is actually going to stick around here for a while, and people aren't really going to cancel their subscriptions just because they're issuing ads. You can still pay for a regular subscription, and even though they've increased prices throughout the years, people have still stuck around. I know my family has still stuck around. So there you have it. Purchase Netflix at 177 if you guys are interested. Dollar cost average from there. This is not financial advice, by the way. It's just something that I would be looking at to purchase at 177 maybe. However, anything under that, it's fair game. And obviously, we are still have a lot more to go in the stock market, as we don't really know where the bottom is going to be. So dollar cost averaging is going to be the smartest way. And if you do choose Netflix to be that stock, we did look into it, did a little bit of research here, and picked it out for you guys. But if you guys actually enjoyed this video, please make sure you like the video, subscribe. I'm kind of switching to this little different format here where it's going to be less edited, just because it saves a lot of time. But I hope you guys like this format. Let me know what you guys think of the video. And thank you guys all for watching. And I really appreciate you guys' time. Good luck in the stock market. Happy investing. Peace out.